The San Fran Fed recently started a program called Fintech Navigate. Can you tell us what that is?
Yeah, absolutely. So about 3 years ago, when we started to hear a lot in the industry around fintechs sort of disintermediating the banking system, we started to kind of do a lot more market intel information uptake in this space. And then the conversation sort of shifted to fintechs partnering more with the banking system. So we then thought, this is a space we really need to keep our eyes on and really make sure we as policymakers, as regulators, understand what's happening and how this industry is sort of evolving, as well as the technologies and the products that are coming to bear from all of this innovation. So we stood up this Navigate program really to promote responsible innovation, to help in the industry sort of understand what, as regulators we're looking for and what laws and regulations they may need to comply with. So that the Navigate program has a couple of different features. One, it has an office hours program. So because we sit, Silicon Valley is sort of in our backyard, we have the opportunity to have these office hours where we encourage firms to come and speak to us. We meet with a variety of different firms in different stages, from the 2-person in a garage to more developed, established firms with products out in the market. And really, we try to both help them understand sort of, how the banking system works, who their regulators may be, help them connect with experts both in the Federal Reserve System as well as other regulators in the U.S. And then in addition to that, we also kind of do more of an info gathering on our perspective in terms of what they're doing, what these products look like, what these new technologies are, how they're developing and how they look like. And then that sort of helps feed sort of our education to our supervisory examiners and teams. So that's the second leg of what we do is really educate our examiners and help them understand when they're out in the field and they're looking at their banking institutions, partnering with these fintech firms. What are the technologies? How do they work? What kind of new risks and factors get brought into the existing sort of realm of the banking institution? And then how are they, managing those risks appropriately given the newer innovation that's happening? And then in addition to all of that, we also do a lot of research. So we do publish our work on our website. If you're interested, feel free to check it out. But a lot of the work we also do helps inform our internal policymakers, our regulators, and really try to do more of a deep dive understanding of what these technologies do, how they work, and assessing sort of the more holistic view of the risks that they may bring to bear.
Great, thank you. Leonard, maybe you could start us off just with what the FDIC is doing on the FinTech Lab front that's launching.
We have set up, or in the process of setting up, an FDI Tech Lab, or FDI Tech Lab, and we're focusing really, broadly speaking, on 3 things with that. One is, and probably primarily, is focusing on consumers, and by that we mean consumer products, delivery of consumers, to try and link or tie in fintech companies with banks. We regulate more banks than the other agencies. Most of those are smaller banks. And they typically don't have the resources or the ability to spend the funds in order to bring in fintech companies. So what we're going to try and do is run pilot programs to bring in fintech companies with those smaller banks to focus on consumers so they can compete better in the marketplace, so they can serve those consumers, whether they be in rural areas or other areas. And that includes different underwriting standards, new products, new delivery channels, and the like. The second thing we're focusing on is going to be assisting banks to try and, if you will, improve compliance with regulations. And probably the best example is Anti-Money Laundering and Bank Secrecy Act. There are tremendous burdens associated with complying with that law. And one of the things we're going to try and do is see if there are ways that fintech companies, in partnerships with institutions, can develop new ways and better ways of complying with the law that are less costly and, quite honestly, more efficient. And then thirdly is really internally focused, and that is we have a supervision modernization project that's been going on for about a year, looking at ways we can improve our supervisory functions of institutions. One is, can we use fintech or technologies to better improve that process as well? So can we do it to spend, in a sense, less time with institutions and use technology to get the same or better results with those institutions.
Great, thank you. Ed, the CFPB has been pretty innovative itself through the use of a no-action process and through a regulatory sandbox. Can you tell us a little bit what those are and more importantly, what the CFPB has learned so far?
Sure. We're doing so much that if I told you all about it, it would take up the rest of our time. So I'm just going to focus on three things that I think are pretty familiar to a lot of people. And we have basically three innovation policies. And they were all, two of them had existed prior to the founding of the Office of Innovation in the summer of 2018, the No Action Letter policy and the Trial Disclosure Program policy. And the third, which is called the Compliance Assistance Sandbox policy, was new and proposed last December. And all three of those were finalized and issued on September 10th of this year. And basically, so I think it's fair to say our approach is to try to use these policies to facilitate innovation in a very material way by having companies apply for relief or assistance under each of those policies and issuing a no-action letter in the case of no-action letter policy, a trial disclosure waiver in the trial disclosure policy, and an approval in the case of the compliance assistance sandbox policy. So I think, let me just start with the no action letter policy very briefly. It's based on a very familiar concept that goes back to the SEC and the CFTC. And the main thing that we've changed from the prior policy is that whereas the prior policy you could get a no action letter that was a staff recommendation of no action, we've now changed that so that if you apply under the policy, the Bureau itself will commit to no action when it issues you a no action letter. We actually issued the first no action letter under the new policy also on September 10th to 1,600 HUD housing counseling agencies. The trial disclosure policy is based on Dodd-Frank 1032E, and it basically gives us authority to permit companies to test alternative disclosures in an in-market setting. And to make that possible, we have authority to give the testing company a waiver for a limited period of time. The main thing we changed with that policy was to build in procedures that if your disclosures test successfully, you will be able to get an extension of your waiver. And then the third one, the Compliance Assistance Sandbox policy, is also based on statutory authority in TILA, EFTA, and ECOA. In each of those statutes, there's a provision that says if you receive an approval from a duly authorized Bureau official, in this case it's going to come from Paul Watkins, the head of the director of the Office of Innovation, you will basically have a safe harbor from liability, both not just from the Bureau, but from state regulators and private plaintiffs. So I think that's really what our main focus is at this point of time.
Great, thank you. Jalapa, why don't we talk a little bit about how fintech lenders are different from traditional bank lenders? The Philly Reserve Bank has been really at the forefront of a lot of the research that's coming out on this. Can you share some of your own research?
Sure. So first of all, everything I said today is my own view and not necessarily the view of the Federal Reserve Bank of Philadelphia or the Federal Reserve System. So I wanted to add a little bit more about what we are doing, because we at the Philadelphia Fed, we don't really have a specific program that already have been described, but because of our general goals of maintaining financial stability and safety and soundness in the banking system. So we have been exploring different issues. We heard from Congressman Foster about CBDC. So central bank digital currency was a private, so we actually are exploring that seriously. There are also a few other programs that we are looking at how to use machine learning more broadly in the supervisory process and overall in the Federal Reserve System. Also, we are exploring we heard earlier about how fintech and financial companies and service companies and technology companies are merging. Banks are becoming tech and tech are becoming banks. So the cloud computing, a lot of information being, so we are exploring how to best regulate and sandboxes options as well. So in terms of alternative data, we at the Philadelphia Fed, we have done some research looking at whether alternative data actually has been able to expand credit to the underserved, as many lenders have claimed. And so far we have only used specific data sets from certain fintech lenders, namely the Lending Club. And so what I have found though is that yes, we do, and the answer is yes. But what we have found also is that not all fintech lenders are the same. So we can't really generalize the results because they use all different, they have access to different data sets. They subscribe to a lot of alternative data from vendors, for example, but they also have their own proprietary information, and that varies across platforms. So when I had the opportunity to do research, by say if someone is going to flag fintech lenders for me to compare with traditional banks, I decline to do that because I don't think I can treat all of fintech lenders equally. But generally, so far we have found that yes, it has provided additional information to give us a more holistic understanding of the person. And so some of the invisible prime, what they call, have been identified. And so that reduces cost of financing to some people.
Great, thank you. Why don't we move a little bit more into the topic of credit access and denial in the age of AI and machine learning. AI and machine learning obviously have a tremendous ability to transform credit access and allocation. And as Jalapa was saying, there's a lot of other factors that some fintech lenders are looking at and making credit decisions. You'll hear from later today from Professor Puri on various factors such as a digital footprint or whether an applicant applies at 3 in the morning or 3 p.m. and kind of what factor that goes into the potential borrower's creditworthiness. I'd like to turn back to you, Ed, and just to see where the CFPB is thinking about the use of alternative credit data in decisions.
Yeah, I think a couple of years ago we put out an RFI on alternative data, and we received quite a number of comments from that process. We also in 2017 issued our first and only no action letter under the prior no action letter policy, and it was to a company called Upstart, which I'm sure a lot of you are familiar with. And as part of that no action letter, we worked out a compliance plan with the company, and they've been testing their results over the last couple of years. And just recently, in August of this year, we put out a blog post from the director of my office, Paul Watkins, and the head of the Office of Fair Lending, Patrice Ficklin, laying out those results. And I think the reason I had pulled out this paper here is I just wanted to get the numbers correct. And basically that the results showed that, and basically the testing was comparing the Upstart's model to a more traditional underwriting model. And it says basically that the results showed that the tested model, Upstart's model, approves 27% more applicants than the traditional model, and yields 16% lower average APRs for approved loans. And there was also fair lending testing done at the same time, and there was the Upstart's model did not have any higher rates of problems in terms of discrimination. So I think that was like a very hands-on way of showing, at least in this one case, that using alternative underwriting models and also machine learning, the way that Upstart can expand access to credit, and that's really one of the main things that the Office of Innovation is trying to do in this area. And we look forward to other applications under all three of the policies I mentioned in the area of alternative data and machine learning.
Great, Leonard, I think I saw your hand up.
Just to kind of echo that, there was a recent study done, or a study done over the summer, and then follow up on that study by a group in DC looking at cash flow data, which people are probably familiar with. And we actually at the FDIC had a meeting yesterday of economic inclusion, and people spoke at that and all. And the data is pretty promising in terms of doing a couple of things. One is bringing in people who have no traditional credit file or a thin file, so they can't be scored, looking at basically bank statements and looking at cash flow. And it found one that is as predictive as credit scores, but also there were a number of individuals who, under this scenario, comparing it with credit scores, would get credit where they wouldn't have gotten credit for credit scores where there were, if you will, thick files, and obviously those who would not have gotten credit. They looked also at fair lending issues, didn't find any correlations with prohibited factors, and also pricing was an important factor of this as well. That is, they were able to risk price the products at a better level for consumers, that is, a lower rate for consumers based on the risk for those. So I think that's one area where we've seen a lot of promise, and I suspect, if the agencies can step back and be cautious in terms of putting impediments in the road in terms of use of alternative data, we'll see more promising results as well in terms of use of alternative data.
Jalapa?
So yeah, I have one thing to add. So how interpret the results is also quite important. With machine learning and big data and AI. And a lot of these fintech platforms also have started to partner with financial institutions that we supervise. And so when banks are required to understand what's inside the black box, how they make credit decisions. And so if they purchase loans or if they use an analytic in the background that using the vendors that they subscribe to, they need to understand how the model works, and so that's the black box concern. Also, third-party vendor risk is becoming an issue, and we are working on a proper guidance for that.
Great, thank you. Why don't we move to the issue of payments? Tayeba, you've thought a lot about payments, the obvious and perhaps not so obvious risks relating to the payment systems, but also emerging instruments like digital currencies and the like. Do you want to let us know kind of what your thoughts are on that and kind of where the San Fran Fed is coming out on some of these issues?
So thank you, Jalapa, for reminding me of my disclaimer. Same thing, views are my own, do not represent the Federal Reserve or the Federal Reserve System or the Board of Governors of the Federal Reserve System. We have been studying sort of this space for a number of years, I think, from both the supervisory regulatory angle as well as the payments space. We do a number of conferences, things like that, annually, where we do a lot of stock taking of what's happening. We had one last year we hosted on central bank issued digital currencies or digital currencies more broadly, and looking at bringing together the technologists as well as the regulators in the room, and kind of thinking about what are the hurdles, both from what the regulators need to consider in terms of the KYC, AML, as well as the consumer protection front, and then what are the technologists really thinking about when they're developing these innovative technologies. And how do we sort of bridge those gaps and help them think about what the regulators need to think about, but also have the regulators think about the maybe potential for these technologies. So I think us in the Fed, we've been really looking at trying to really understand these technologies and making sure that we know them from how they're built and how they work, so that we can assess those risks appropriately, and then engaging with our fintech firms to really understand the regulatory and the legal aspects of that. We do a lot of research, we do a lot of conferences, and then I think the Faster Payments Task Force was stood up to really help the U.S. more broadly think about how do we get more of up to speed with real-time payments, and bring more of that collective energy from the industry as well to think about what are some solutions and recommendations that they may provide, and they put out a number of reports, some really great work. So I'd say a lot of internal research, but also industry engagement through a variety of different channels.
Great. It's when thinking about fintech and payments and digital issues, it's striking to me just how old the legal architecture is in our laws. The Gramm-Leach-Bliley Act, of course, is 20 years old. You have the Truth in Lending Act, which came out the same summer as Woodstock and the moon landing. You have the Electronic Fund Transfer Act, which came out the year I was born, which is 40 years ago. So we have a lot of old statutes, but new uses, new technologies, and I'm curious about where the panel thinks about how examiners and regulators are grappling with applying these I don't want to say outdated, but these legal regimes that are very much set in a different period to new technologies. And to that, Ed, I'm curious just from the CFPB, which obviously has a great role in these consumer financial protection statutes, how it's thinking about the role of modernizing disclosures. There's obviously a push by other regulators in other areas about plain English disclosures and the like. And where's the CFPB coming out with that, particularly when you're thinking about people here who may not come from a traditional regulated space, right, but wanting to meet the expectations, the emerging expectations of regulators on this front?
Yeah, I mean, I think there are two levels of this. I mean, I think we're certainly very, very well aware of the issue. We have on our long-term agenda the idea of trying to change, revise our regulations to deal with the digital age. That, of course, is the rulemaking process is a slow-moving, long-term process. So in the interim, we have, as I mentioned, the trial disclosure policy as a means through which we could perhaps give more timely guidance and relief in this area. And I think we're very interested in this. For the trial disclosure policy, one of the main things we're interested in is companies who have an alternative way, and they think a better way of disclosing the required information to consumers through digital means. You can apply under the policy to test your idea for a limited period of time. I think in the policy we say we're sort of thinking 2 years. And again, as I mentioned before, assuming the testing goes well, we're very much inclined. I think we'd be very much inclined to extend the period during which you could use that. And then I think the great thing about 1032E and this policy is that it allows that kind of in-market testing, which we or other agencies cannot do on its own, because we have to do laboratory testing normally when we test disclosures. So we could get that information from the trial disclosure policy and feed it in to a rulemaking to change the regulations to make them more like the trial disclosures, and then that would be something that all regulated companies could use to ultimately to increase consumer understanding of the information that they need.
Great.
So I think it's great the CFPB is looking at changing the regulations to try and adapt it to the new world. That's an ongoing process. One of the things that we have seen deals with, if you will, kind of backroom operations where institutions are partnering with fintech companies and let's just say looking at different underwriting models. So one is using alternative data or using artificial intelligence and like. And my sense is, generally speaking, most of the regulations don't address that, don't prohibit it and so forth, so you have to fit it into the existing structure. For the most part, that involves two things: fair lending and Regulation B for credit scoring models, and then secondly, model risk management, kind of on the safety and soundness side. One of the things we've heard, or at least that I have heard from both fintech companies and from banks, is not at the policy level in terms of the agencies in Washington, but at the examiner level. That when examiners encounter something that's new or different, or at least new or different compared to existing underwriting models, they are, perhaps not inappropriately, skeptical and looking at those, but trying to fit them into existing structures, and there's no guidance out there. And by nature, examiners and institutions are very conservative, and so they're hesitant to say, yes, this looks okay, or to give really if not a green light, just a yellow light, as opposed to sending a different message to institutions. So one of the things we're looking at is really trying to get the right balance for examiners when they're looking at institutions and looking at innovative ways of underwriting or other things. Obviously, they have to comply with existing laws, whether it's fair lending laws and the like, but to not try and stifle or put impediments in kind of testing those new ways of doing things.
Shalava, you want to add
So
something?
yes, I'll add quickly. Cyber risk is another one that we are thinking of now that cash flow data, a lot of APIs now. So third-party outsiders have been going into the bank accounts and credit card accounts and taking data. And so from my understanding, not being an IT expert, is that so if the bank's legacy system is designed in a totally different period or different system by different people than the tech firms or firms that go into the banking system, the security process that has been designed to supposed to be safe, it may not work. And so there is cyber risk that is now increasing. And so we are also, because a lot of data also is now being in the cloud and cloud computing and now providing services to banking institutions. So we are, again, third-party vendor risk is important.
That's a nice segue to the issue of regulatory coordination. There's obviously the FFIEC, the Federal Financial Institutions Council, which serves as a forum for the regulators to take up issues under the Bank Service Company Act and other statutes, but also in the role of technology service providers and the examination of TSPs through the FFIEC's framework. I was wondering if anyone on the panel wants to talk a little bit about regulatory coordination, because obviously, for example, the CFPB and the FDIC and the OCC have innovation offices, but are you talking to each other in terms of issues that you're seeing from your own regulated institutions and sharing that information?
Yeah, so we CFPB, the Office of Innovation, the CFP is definitely it talks to the other federal agencies on a regular basis. I mean, particularly the OCC's Office of Innovation that's been set up. I think in the case of the FDIC, that's very much what our expectation is once that's up and running. And similarly, we have a lot of different ways of interactions with the Fed, including with a former colleague, Calvin Chen, at the Fed, who has been responsible for a lot of that work. In addition, we, again, on the magical date of September 10th, we announced the launch of something called the American Consumer Financial Innovation Network. Glad I got that right. The acronym is ACFIN, and it's based on GFIN, the Global Financial Innovation Network, of which the Bureau, the Office of Innovation at the Bureau is a member, and that organization started again in the summer of 2018 or so, GFIN I'm talking about, and it's a way for regulators around the world really to coordinate on innovation, and we're one of the, I forget the exact word, maybe the managing members of GFIN, and so based on that model, the Bureau launched ACFIN, and it's really based, the idea is to have this similar kind of coordination among federal and state agencies in the United States. I think on September 10th when we launched, we had 7 states. I think we're now up to 11 or 12 states. And we're actively seeking other members. And I think that will just be a forum through which it'll make it easier for the Bureau to coordinate and potentially other federal regulators to coordinate with state regulators and state attorney general's office in the area of innovation.
Great, thank you. Tayaba, you've thought a lot about, as a fintech advisor, about what we in the United States might be doing better, or what we need to improve, vis-a-vis our counterparts abroad. What have you learned in terms of what regulators offshore are doing to foster innovation, and perhaps, are there recommendations for what we here can do better?
Yeah, I mean, great question. I think, it's so hard to make that comparison, I think, because when you think about the regulatory framework in each jurisdiction, it's so different, and it's sort of evolved to meet the needs of those specific regions. Similarly, the markets are a lot different, the context in which that innovation happens, the players are very different. And so when you think about making those cross comparisons, I think it's rather difficult just because by the nature of the regulatory regime as well as the market itself the context within that is so different. But I think, when we do make some, we see a lot of innovation that do come from offshore. We think about countries that are now offering digital banking licenses. We can say, yeah, that's a leap forward. But I think in the U.S. here, we've allowed our banking institutions to operate in a digital capacity for over 20 years now. So, I mean, in a way, we've been sort of ahead in that game. And then we think about sandboxes and what other countries are sort of doing in that space. While we here in the U.S. don't have any formal, I think at the federal level, formal sandboxes, we do, have a variety of different licensing regimes. We have different charters that we offer, and so the opportunity for firms to sort of, get a license within a smaller market, like at a state level, and then maybe test their products and their technologies within that regime before broadening scale to the other 49 states. That I think serves maybe as an informal way to do some of the sandboxing that we see in other jurisdictions. So I think, we really have, when we make those, when we ask those questions, just sort of thinking about where the regulatory regime and how the evolution of the market has been. And even when you think about, the payment space, here in the US, we've, built legacy systems that are very old, and you see other countries sort of leapfrogging the credit card rails and things like that, moving to electronic payments. But our consumer base here is so much more comfortable with credit cards that having that shift to the mobile payments or electronic means of payments hasn't been, I think, as drastic as we've seen in other countries. And so, I think there's that context is so important when you think about innovation and how it's happening compared to other jurisdictions.
So I have seen a picture of Becca in China that with a QR code right next to him. So.
Great. Well, we have less than 3 minutes, and we wanted to provide an opportunity for the audience to ask some questions right here in the front.
Yep. Question for Leonard Chanin and Edward Blatnick related to the credit access and denial in the era of AI. You talked about acceptance rates and interest rates and fair lending concerns, but I didn't hear you talk about outcomes. Are the borrower outcomes from these loans similar to borrower outcomes from more traditionally underwritten loans?
Yeah, so I'm curious about the catch box there, but I guess you caught your question. I don't know. The data I've seen, and I think they looked at it over the past few years, suggests that the default rate is lower than or equal to traditional credit underwriting. But I don't know how comprehensive that data is, but at least what I've seen for the last few years suggests that it is equally predictive. Now, one thing I'd note is, we're in a non-recessionary period. So one question is, how will these models perform when, when and if, whenever a recession comes? But my sense is that will be reflected in cash flow data that institutions are looking at. But if you make a loan today, what's going to happen, in a year and so forth? But I think some of those same problems exist for existing credit models in terms of, you can't predict the future and the like.
Yeah, and I think just in a general way, my understanding of that is the same. I think in the case of Upstart in particular, I'm pretty sure that aspect was not part of the testing protocol, so I can't really say in that particular case.
Okay. Another question? Yes, sir.
Yeah, I can actually speak to that outcome. The Upstart report, their net losses actually stayed the same. So they raised acceptance by over 100% with net losses staying static, which implies they cut them in half. One of the things you mentioned, Leonard, was when auditors go in, they end up coming out with yellow lights. How do we move that to either green lights or red lights? Because as a startup, all I hear with yellow lights is more legal costs.
Yeah. So I think there are a couple of things, and I think, quite honestly, it's something that the agencies have to work on, both the FDIC as well as presumably the other agencies, and that is to train examiners about how to approach new ways of doing things, new models, whether it's underwriting or whether it's fraud prevention, so forth, to look at those, they have to fit them into the existing regulations because, you know, we're examining for compliance with whether it's, you know, Regulation B and so forth. I think it's to basically step back and ask questions and, one, become educated before you go into institutions so to understand these models. There's lots of data out there. So part of it's training that we need to do. And then secondly, quite honestly, to have more frequent communications with Washington on new or unusual ways of designing products and the like. So I think it's, quite honestly, it's on us to do that. I think you can try and educate your partners, financial institutions on that, but ultimately I think the examiners are going to need to get a comfort level on. And I think it'll take some time, in truth.
Any final words from anybody else on the panel on that point?
So just, you know, the work that we do in the SFN, and I think across the other agencies, is really like trying to understand these new technologies and really helping our examiners be educated on what these technologies do and how they work, and so that they can go out in the field and make the right risk assessments when it comes to these new products.
Okay, great. Well, thank you very much. You know, we can't talk about innovation without having the regulatory overlay, and you know, you've been very much an important part of the conversation. So thanks to our panelists, and we'll move on to the next panel.